Hello, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, where we continually endeavor to help you master your wealth. Today, I'd like to highlight our year-end market review and outlook for 2022. One year ago, we stated that we were encouraged about the opportunity for stocks to perform well in 2021 as the large available cash savings of investors, plus the post-pandemic recovery in economic activity, should propel stocks to new highs. Additionally, we indicated that bonds were very expensive and stocks were better values. Indeed, the stock market did do exceptionally well as both the S&P 500 and the Russell 1000 indexes rose over 26% in 2021, despite the ongoing impact of COVID-19 variants and political wrangling over the infrastructure and Build Back Better bills in Congress. Bonds lost money last year as the economy rebounded and interest rates moved higher. In the fourth quarter, large cap stocks outperformed mid and small company stocks as accelerating COVID cases caused investors to move to the perceived safety of larger, more well-established companies. International stocks were a mixed bag in the quarter as more developed markets such as Europe and Japan saw modest returns, but emerging markets experienced losses as the Chinese market declined over 5%. The U.S. economy was robust in the quarter, with retail sales rising 8.5% from 2020 and nearly 11% from the pre-pandemic 2019 levels. S&P 500 earnings estimates for the fourth quarter are predicted to grow by 19%, and the Conference Board estimates fourth quarter real GDP growth to be 6.5%. Additionally, the U.S. unemployment rate continued to drop during the quarter. However, inflation became a much more serious concern in the fourth quarter as the Consumer Price Index reached a year-over-year gain of 6.8%, the highest in nearly 40 years. Despite the sharp increase, long-term interest rates did not reflect that concern as they were virtually unchanged for the quarter. Regarding our 2022 outlook, our base case scenario, we expect 2022 to be another positive year for stocks, but caution investors that the overall returns for stocks are likely to be lower than the last 12 months, and volatility is likely to be higher, following 3 consecutive years of above-average market returns. We feel bond performance will be challenged again this year by a strong economy and a less accommodative Federal Reserve policy. We believe there are several key market drivers for 2022. First, while stocks are still expensive relative to their history, they're reasonably valued relative to the low interest rate bonds. Within the stock market, we favor a combination of both secular growth stocks and economically sensitive value stocks, along with an allocation to historically inexpensive international stocks. Secondly, technological productivity and a more financially secure U.S. consumer continue to power the U.S. economy and corporate earnings despite COVID-related headwinds. Companies have become much more efficient during COVID and have, in general, been able to maintain their profit margins. Consumer balance sheets are in much better shape than in the past as household debt service to disposable income ratios are low and consumer savings balances are still high because of the stimulus payments during the past 2 years. And lastly, inflation is likely to peak in 2022 as supply chain shocks ease. We believe that much of the current inflation surge will prove temporary, including the energy and supply chain issues. While peaking inflation does not necessarily mean low inflation, any deceleration in the current uptrend will likely be welcomed by the markets. The 3 biggest risks to our forecast are, number 1, COVID variants may continue to stall the global economic recovery. While COVID death rates in the U.S. and globally have likely peaked, variants still represent a threat to economies as the cases of the Omicron variant are spiking. However, as more people are vaccinated and/or infected, we move closer to the herd immunity levels needed to dramatically slow the progress of the disease. Number 2, high inflation may be more persistent than we expect. Inflation data is running well above the Federal Reserve's 2% long-term target, and if COVID restrictions persist through the first quarter, this could lead to ongoing higher costs for goods and services. While we agree with the Fed's position that many of these costs are temporary spikes reflecting the year-over-year comparisons with pandemic lows, any further indications of rising inflation would likely lead to higher interest rates that could pressure both the stock and bond markets. However, if inflationary pressures ease next year due to the supply chain bottlenecks abating and the ongoing deflationary benefits of cost-saving technologies, long-term interest rates may remain range-bound, and the Fed may delay increases in short-term rates. These would be positive developments for the stock market. And number 3, earnings growth could be more than offset by valuation contraction if interest rates rise more than expected. S&P 500 earnings projections for 2022 are for a 9% increase. This is a marked deceleration from the 45% projected growth in 2021 and may not be robust enough to offset a potential PE contraction from today's elevated levels should the Fed take more aggressive actions to constrain inflationary pressures. Thank you for watching today, and I hope you'll enjoy reading our full year-end market review and outlook for greater detail on the fourth quarter and our forecast for 2022. Take care and have a happy and prosperous 2022.